DeWaal here, and this is Bridging the Week from May 4th to 8th, and today is May 11th, 2015. Good morning. For the third week in a row, a case involving allegations of spoofing highlighted news in the financial services industry worldwide. Last week, the CFTC brought an action against the same two traders that the CME Group had summarily barred the week before from accessing all its exchange markets for 60 days for allegedly engaging in disruptive trading earlier this year. Separately, the SEC approved a pilot program to increase the minimum tick size for quotes and executions in certain small capitalization stocks, while FinCEN and the U.S. Department of Justice sanctioned two related purveyors of a virtual currency for not maintaining robust AML procedures. As always, it seems, we have a lot to cover this week, so let's get going. Last week, the Commodity Futures Trading Commission commenced a lawsuit in federal court in New York against Heet Kara and Nassim Salim for spoofing activities on the Commodity Exchange, Inc. from February through at least April 28, 2015. The respondents were alleged to have engaged in disruptive trading involving gold and silver futures contracts. Previously, both respondents were summarily suspended by the CME Group from accessing all its marketplaces for 60 days for the same conduct. On at least two occasions, alleged the CFTC, Mr. Kara placed multiple small quantity layered orders on one side of the market to help effectuate an execution of a few small quantity orders he previously placed on the opposite side of the market. Once some of the few orders were filled, Mr. Kara canceled the multiple layered orders on the opposite side of the market. Mr. Salim engaged in the same similar disruptive type trading practices, and Mr. Kara and Mr. Salim sometimes coordinated their disruptive trading activities, claimed the CFTC. In connection with this matter, the CFTC charged Mr. Kara and Mr. Salim with disruptive trading under federal law and CFTC rules, and simultaneously obtained a freeze against all assets of the respondents. The CFTC seeks an injunction, disgorgement of profits, and a fine. Two purveyors of XRP, the second most popular virtual currency after Bitcoin, were fined $700,000 US last week by the Financial Crimes Enforcement Network and the United States Department of Justice for failing to comply with FinCEN's anti-money laundering requirements. Ripple Labs, which operated as a money services business and sold its virtual currency XRP to the public, was sanctioned for not registering as a money service business and implementing and maintaining an effective AML program as required by FinCEN during parts of March and April 2013. XRP LLC, which was set up by Ripple as a subsidiary and partial successor of its business, and also operated as a money service business, was sanctioned too for not implementing and maintaining an effective AML program at various times from July 2013 through March 2014. XRP LLC was additionally sanctioned for not reporting various suspicious transactions to FinCEN. Generally, firms selling and buying virtual currency to the public for fiat currency, so-called exchangers, are required to register with FinCEN as money service businesses since March 18, 2013, and are required to have an effective written AML program and to report certain suspicious activities to FinCEN. Separately, last week, the New York State Department of Financial Services granted its first charter under New York banking law to ItBit Trust Company, a commercial Bitcoin exchange. The New York State Department of Financial Services expects to issue its final BIT license regulatory framework for purveyors of virtual currency later this month. At such time, ItBit will be required to comply not only with requirements of a trust company, but its requirements under the new BIT license regime. The Securities and Exchange Commission generally approved a proposal by the National Securities Exchanges and the Financial Industry Regulatory Authority to widen minimum quoting and trading increments for certain stocks with smaller capitalization. The objective is to assess whether such changes might enhance market quality. The pilot program will include stocks of companies with $3 billion US or less of market capitalization, average daily trading volume of 1 million shares or less, and a volume-weighted average daily trading price of at least $2 US. This new pilot program will begin by May 6, 2016 and include one control group of 1,400 securities and 3 test groups of approximately 400 securities, each subject to different conditions. One test group will have pilot securities quoted and traded in minimum 5-cent increments subject to certain conditions and exceptions. Recently, Chen Yao, an assistant professor at the University of Warwick, and Miao Yi, an assistant professor at the University of Illinois at Urbana-Champaign, published a very qualitative study entitled Tick Size Constraints, High-Frequency Trading, and Liquidity that argue that large relative tick sizes and low-price securities decreases price competition and increases the importance of speed for trade execution, thus helping high-frequency traders and not necessarily improving market quality. ICE Futures US fined EOX Holdings LLC $200,000 US for various infractions related to its handling of block trades from July 2013 through February 2014. Among other violations, IFIS alleged that EOX, on multiple occasions, submitted block trades to the exchange that were below minimum quantity thresholds and reported trades outside required time periods. On multiple occasions did not comply with record-keeping requirements for customer orders and failed to supervise certain employees. EOX consented to the fine without admitting or denying any of the rule violations. Block trades on ICE Futures US are strictly prescribed. Check out details on the article version of Bridging the Week on the website. And finally, in a presentation before a committee of the European Parliament last week, Commodity Futures Trading Commission Chairman Timothy Massad argued that United States clearinghouses effectively imposed similar margin requirements on their members as European clearinghouses. As a result, the regulation of U.S. clearinghouses should be deemed equivalent to the regulation of European Union clearinghouses, said Mr. Massad. Although European banks will be subject to punitive capital requirements for exposure to U.S. clearinghouses unless they are deemed to be subject to EU equivalent regulation. A determination is required by June 15 to avoid such consequences. According to Mr. Massad, although EU clearinghouses are required to use a 2-day liquidation period to calculate clearinghouse margins, such margins are collected on a net, not a gross basis. However, in the U.S., said Mr. Massad, clearing member customer margins are collected on a 1-day gross basis and typically result in a collection of substantially great total margin by the clearinghouses. Although Mr. Massad did not prevail in his arguments at this time, he and Jonathan Hill, European Commissioner for Financial Stability, Financial Services and Capital Markets Union, acknowledged, quote, discussions are constructive and progressing, end of quote, and, quote, have been mutually satisfactory on the issue of the ability for both sides to potentially defer to each other rules, end of quote. Well, that's it for this week's Bridging the Week. As always, there is more information in each article, and more articles on the article version of Bridging the Week on the website. Check it out. Until next week, this is Gary DeWaal. Have a great week, and ciao!